Okay, good evening guys. Before we get started, as always, let's do the customary instant poll. Let's check everyone can hear the volume correctly tonight. Standard settings for me, so it should be fine for everybody. Let me know if the sound's perfect, too loud or too low. Keep talking for a few seconds. Okay, one saying too loud. Okay, Tomas, you might want to turn that down on your speakers then. The majority of people are saying it's perfect. All right, that's great. Good enough for me, guys. Thank you. So we're going to continue the Trade for Life course tonight with money management and fundamental analysis. So we've really got an understanding of why we need a trading plan, the theory behind it, what it actually is, how to get into a routine, how to kind of deal with the negatives, the positives, and all these different things that really make us a complete trader. It's funny because I'm just on another edit of my book, which is kind of the final round now, and it's just going over all the things that I wanted, to really to put across to people. And I've been trading a lot more over the last kind of 2 or 3 weeks because I'm kind of thinking of opening a trading room and some other things. And the market's so very, very volatile right now. It's just so important that I keep going back to my core principles of being prepared, understanding that you can trade the markets from this fundamental data. There's so much of it, so much fundamental information. This morning, the retail sales data came out terrible. The market sold off, but they were selling off before that. There's all the mix-up when the sentiment figures came out today, and then straight after we had the housing data, and instead of 450 was expected, it came out actually 481, but was printed on the newswires as 1,032,000. So all these things you have to be, aware of are just so vitally important. But if you're not ready for that information, you're not ready for the stats, you're not ready for the direction of the market, you don't understand the correlation between the 80-20 rule that I keep banging on about, that market is going to move 20% of the time due to fundamental information, but then 80%, that whole 80% that it adheres to, that technical analysis, support and resistance framework, that if you don't have this on your charts at all times, you're going to be on the back foot and just not going to be able to react quickly enough. So all these things that I again take for granted after so long of doing these things, I just find it amazing that people still don't have that planning and preparation, don't have the ability just to be able to react, at a split second to news, or react, and know what a key value is, in relation to support, resistance, and simple things like Bollinger Bands, RSI, your Fibonacci levels. Again, it's very, very important that you can react in a nanosecond, because that second of understanding, assimilating that information and clicking the button can be the difference between getting a fill and not getting a fill, or getting a fill too high or too low down the range and actually losing money on the right kind of idea. So it really is cutthroat, and it's dog eat dog, dog world. And if you're not prepared to be in that mentality, you're not prepared to be in that situation, then you need to be a different style of trader, as in you need to be an investor. You need to probably trade with a broker and trade things longer term, because the whole point of being a spread better, being able to access many markets at very, very quick notice, is that ability to act on your own knowledge, your own technical fundamental understandings, and get in that market, get your profit out, and that's what it's all about. So before I start, as always, the risk warning. Remember that spread betting and CFD trading carry high level risk or capital growth, losses linked to each initial deposit. It might be suitable for everyone, so please ensure you fully understand the risks involved. The information currently provided here under no circumstances are considered an offer solicitation to invest. Nothing herein should be considered investment advice. The information provided is through accurate date it is produced. Education only. Content of the webinar is posted by the moderator on intro.com. Content does not constitute financial investment or tax advice. Intro.com does not accept any liability for the content of comments made during this session. So when we talk about money and risk management, what we need to understand is any successful trader needs to be able to identify winning trades. So the gauge of your success, however, is not really solely on how far on side you can get a trade. Without that kind of ample risk reward and money management, then really you're almost kind of betting, because just to get on side in a trade is really only half the element. You need to understand that you put a trade on, so you paid your spread, so you're instantly offside in your trade because you paid that spread. And you have to understand, are you going to make 2 times your money, 3 times your risk, whatever it's cost you physically in money terms to put that trade on? What are you going to get out of it? And again, it all revolves around the same things. How much are you looking to make? Goes back to your plan. How much are you prepared to risk? Goes back to your plan. How much ideally do you want to make? Goes back to your goals, which is in your plan. Okay, because you can get a trade, you can put it on, and very quickly can hit your initial target. And if you don't get out, it can quickly come back to you and even go offside. So many a times I've sat there thinking, right, £100, £200 on side, I should probably take that. Because I'm not really trying to make much more than that in a trade. But you always get that kind of bit of greed and think, well, let's just see if it breaks this next level up, how far it can go. All of a sudden, some profit taking takes place, and you're down to £250, and then you wait for the next support to be hit if you buy in the market. Then it goes to £100. Then all of a sudden, you're taking £60, £70 out of a trade when you could have taken 200. Now, if you do that in day out, week in, week out, month in, month out, that can quickly add up to hundreds, thousands of pounds. And it's all about being prepared to know you've taken that risk on from that point of time. You understand how long you want to hold the trade for. You understand how long the markets take to move in order to make your profit. And then you have that exit point to bank that profit. It's called not leaving money on the table. So you don't want to constantly put your trade on and see it go onside, offside, onside, flat, onside, and then you take some profit. Because every time that trade's onside, if it comes back to you, you could get in, or you could average in, you could get out, put a separate trade on. There's all different things you can do. But if you keep saying, £50, £100, £50, £100, flat, out the trade, then you've given the market back £50, £100, plus that £50, and whatever else in between. Yeah? The whole point, if you're trying to run trades, that's fine. I respect that, and that's great. If you're trying to run trades, then you're a different type of trader. You can leave money on the table because you're not expecting to get £100 or £50, you're expecting to get £500. So you have to let the trade run. But if you're a small, almost momentum scalper in and out the markets and you've got that risk set, if you've risked £20 and you're £50 on side, take it. If it comes back to you, buy it again, sell it. I know it's a lot easier said than done, but you have to understand what trader you are. And you have to understand if you put that risk on, it has to pay. There's no point if you're putting a trade on, putting your stop to a scratch, and then getting scratched out. The only person winning from that is other people in the markets and your broker, because you're just paying money to not make anything. So what you have to do is when you've taken that risk on and you see some profit, you've got to take it out. Don't leave it on the table. So again, it has to be down to you. You have to understand what you've risked, what you're willing to make, what you think's value for your time, what you think is a good amount of money. Because if you don't, all you keep doing is scratching out trades, generating spins for brokers, and not really doing anything. Get a bit disheartened with trading. Then it's boredom, then you do a big trade, then you lose, game over. It's just the way it goes. If you don't trade with money management and have that understanding of where you get your profit out, then really just gambling. If you just say, well, I'm going to buy the FTSE, I'll just leave it, see what happens for a few weeks. What's the worst that can happen? Well, anything can happen. The markets can move very, very quickly and on very little information these days. So without, again, putting this into context, then you really just again, being a bit of a punter. So I mean, managing your potential risk, think of it like a round book. Think of it like a casino or a bookmaker. Don't say any poor casinos, don't say any poor bookies, because they know. They know if they take X amount of money, then they take X amount of money over the top. Maybe 5%, 10%, 20%, doesn't really matter. So what you have to understand is if you trade in a certain way for a day, a week, a month, a year, that you're going to win 7 trades out of 10 on the whole. Your risk management means that your winners don't get overtaken by your losing. So even if you only win every other trade, 50% of your trades, if your risk management's right, you still make money. And that's how winning's done, guys. That's how trading's done. It's making a small number of winning trades time and time again with a calculated, solid risk. It's a marathon, not a sprint. It can be boring, but that's the whole part of the challenge, the whole part of the game. Yep, if you can risk 20, 30 quid every trade and make 50, 60, 100 quid every trade, you know what? It's a way to make money. But it don't matter, Tony. It don't matter if you're unsure or not. It's the way it is. I've taught more traders than anyone else I know. Been involved in the markets for 14 years. If you're just going to go for the big trades and get that one-off big trade, overall, you will get caught out and you will lose money. It's as simple as that. I've seen it 1,000 times. That's why I'm taking these presentations. That's why I'm the Chief Market Strategist Trader. And that's why I write books on these things. Because if you try and be the maverick, the one that goes out on its own, because I've been the maverick. I started off as the maverick. £10,000 I made in my first trade. So I thought I could take on the world. And spent the next couple of months giving it all away. An untold tens of thousands after that. It took me a long time to figure out. There's a time and a place for being a maverick. There's a time and a place for the big trades, the holding the trades. If you want to be just good at trading, yeah, limit your risk, get in, make a little bit of money, then do it again. Yeah, repeat it. You're not just going to get on the golf course the first time and be Tiger Woods. These things take time. Okay? Believe me or not, doesn't really matter. I have nothing to prove. So money and risk management are not just about managing the downside. As I've said, a massive part of this is managing the upside. Everyone, when it talks about risk and they talk about the negativities, where do I stop? When am I wrong? Where do I get out? How much did I lose? Again, speaking from experience of being a professional risk manager for some of the biggest traders in the world, at Revco, when I spoke to you, it was bad. If you got the phone call from Stephen Risk, it was bad. I never came out to say, if I rang you up, it was never for good news, to say you're coming out for a beer tonight. It's because you're in trouble. You'd lost more than you're allowed to. You had to get out of the trade. If it came out on the trading floor, generally meant you were fired. Okay, so there's no good things associated with risk. But after a while, again, like most things, I started to address it in a different way. It's very important that we understand that risk is a two-pronged thing. Sorry, Rudy. Rudy's just saying that the sound's coming in and out. Is that the same for anybody else? Is the sound fine for everybody? Okay. I don't know, guys. I mean, it's one of them things. We have different connections all over the world, so sometimes it's the other end. We've done a lot of presentations, hundreds and hundreds now, and the sound's been fine. Okay, Rob. Okay, well, all right, guys. Well, just bear with me for this presentation tonight, and I'll get onto the technical team and see if there's any kind of major problems. But yeah, all right. Thanks for bringing that up, Rudy. So as I said, it's not always about that negative connotation of risk. The upside is just as important. And as I said, if you're a short-term trader, you can see them profits, flash up on your screen very quickly. And if you don't book them, they're gone, and sometimes they're gone forever. So you have to be prepared to get out, for that not always optimal profit, but a profit's a profit. Do you know what I mean? It's, as I said, how many times have you done that? What if? What if I'd left that trade? I'd have made loads of money. Or what if I'd have just got out of that trade earlier? I wouldn't have lost as much money. Or what if every time I'd have seen some profit on my screen, some good profit, so calculated where was a good area, and you just took that good profit every trade? Do you think you'd be better or worse off in the long term? Not hard to say. I think we're all going to say we're going to be better off. And again, guys, this is just from thousands of trades. Thousands. Watching and mentoring hundreds of top-class traders and teaching people over the years, you see the same thing over and over again. You can only kind of go back to things like, if you keep hooking your golf shot, you keep hooking it and you keep playing it, what's going to happen? You're not going to change anything. You go to a pro, he says, you need to change your stance, lock your wrist in, bend over a little bit more, keep that knee locked. All of a sudden, you're hitting it straight. Sometimes you just need somebody to tell you these things. And it's the little things that make the biggest difference in trading. So your initial investment. Now, let's face it, guys, it takes money to make money. You can only manage money if you have some to trade with. Now, your capital controls how often you trade. And again, it controls everything you do with trading. You can put multiple trades on. You can do some short-term hedging. You can average into trades. You can be a lot more aggressive when you have money in your account. It's very difficult to trade with a small account, but not impossible. Okay, I've gone back to starting trading, for my trading room, for some signals I'm putting out, just for my general live sessions. I started with a £5,000 account. Okay, so I'm up to £8,000 in the last couple of weeks. It's not been that difficult in such because there's been a lot of news and the markets are very volatile and there's lots of movement. But again, you make money from having money. That's the way it is. But I'm not out there trading a £200,000 account, £1 million account, saying this is easy. Trading with a relatively small account, relatively low risk-reward ratios, get a trade, put some on, when I'm in profit, take half out, let some run, and just keep doing that day in, day out. So, as I said, if I'd have held 1 or 2 or 3 of my bigger trades, probably would have made about 20 grand. But that's the whole point. I'm not interested in trying to do that. I'm trying to make little bits of money, from good quality trades. You don't always have to be in the low and sell out of the high. There's plenty of different ways of trading. As we know from all the different things we've talked about over the years, I don't see the markets the way you do. And you don't see the markets the way I do. But I have a strategy, I have a plan, I have an interaction that I'm comfortable with. And that's what you need to find. A way that you're comfortable with interacting with the markets. Doesn't mean you have to have everything has to be a 20-tick winner. Doesn't mean that you have to be right 7 times out of 10. Doesn't really mean anything. As long as at the end of a day and a week, you come out with some profit, you're happy in the way you did it, and you understand, then that really is good enough for me. Okay? There is no set way of trading. Okay? As I've said, Going back to things I've written in my book, I was taught by some very smart guys when I first started to trade, and they said, listen, Steve, do you know what? Trading's just a game, okay? And money's just a way of keeping score. If you understand the people that play the game, you understand trading. It's no more difficult than that. And do you know what? It stood me in good stead because it teaches you not to take things personally. It teaches you humans trade the markets. I know we all want to blame some robots, some investment banks, the bad traders, all that kind of stuff. The markets are just the market. Can't really do anything. Do you know what I mean? It is what it is. All right, Rudy, you're going to have to stop asking so many questions. If you can't hear the sound, then, again, I'm not here to do an open talking session. Do you know what I mean? If you watched this course a few times, the whole point of what I'm telling you is, this course changes, not in what it says, but it changes with market conditions, all right? If you're seeing, a 15-minute candle printing 50 ticks, what's the likelihood, or an hourly candle printing 50 ticks, what's the likelihood of the next candle opening and going another 50 ticks? Take profit when it's on the table, when it's there for you. Okay, there's different styles of trading. I'm just telling you how you can trade the markets and make money right now. When there's lots of volume, lots of volatility, and things are moving up and down very quickly, get a trade on side, take some profit. If you think it's going to go higher, do the same trade again. Buy higher up and take more profit. Again, well, I don't know what you want me to say half the time, with these presentations. I can't do any more than trade live data and show you how to make money. I can't give you signals during the day and show you how to make money. I can't make money for you. If you want to give me your money and manage it for you, then I can. If you want me to teach you how to trade, then this is it. You have to take on board what I say. You've got to understand that it's for your own good. And what you have to do is take all the elements and make your own trading plan, your own trading strategy and style. It doesn't matter how many books you read. It doesn't matter who you watch. It doesn't matter what you do. It is you pressing that button and you're on your own versus the market. That will never change. If you can't handle that and you can't get on board with that, then you can't be a trader. It's as simple as that. Simple. And everyone's looking for the Holy Grail. Everyone's looking for the answers. Okay, it isn't out there. The answer is in you. You have to look at the markets, make a decision, press the button, and get in for a reasonable risk to make a reasonable reward. That's it. Everyone loves to make trading more complicated. Let's do a Sharpe ratio. Oh, let's calculate this over the mean average of, my last 1,000 trades. You won't make it to 1,000 trades if you don't have a basic risk reward. If you don't have a plan, you get disillusioned with trading. You do something stupid and you lose your account. Okay, this is it. This is Steve Ruffley's guide to trading. This is it. It's hard, and sometimes it's boring. Sometimes it's not the answers you want. But it's like everything in life. Sometimes you just have to be told. And if you're not willing to listen, and you're not willing to kind of take these things on board, then there's no point in trading. It all comes down to investment. So again, if you put it in a business analogy, a lot of businesses fail because they're undercapitalized. If you put £100 in an account and think you're going to be trading for a long time, you're wrong. You're not going to be. Simple. Okay? If you put £1,000 in an account, you're buying yourself some time. All you're doing by putting that money in your account is buying yourself time. Nothing else. You're buying yourself time in the number of trades you can do, buying yourself trades in the number of times you can actually put trades on, and buying yourself time to overcome them losses. You won't always win. You'll generally lose when you first start trading, or you might win a couple and then have a losing streak. No matter what, there'll be a losing streak. But the more money you have in your account, the less impact that losing streak has on you. Yeah, being able to bounce back from losing trades, bad trading sessions, days, weeks, or months is part of trading. Sometimes the easiest way is just to stop trading. The fact of the matter is, you're not going to win every trade, and trading will just be sometimes difficult. And that's because of all the different complexities we've talked about, the different correlations between markets, what's happening in the world fundamentally, what's happening in the markets technically, what the 1% are doing, what the rest of the world thinks is going to happen. So again, what you're trying to do is just understand that, when you put money into your account, it's not like you have to double that account every day or every week, every month. That the whole point of having this longer term plan is that, your margin, the amount of money you have enables you to trade the way you want to. Okay, and that can be small, it can be big, but if you trade big, you can't trade as frequently because you've got the risk of losing. If you trade less often, then you have more chance of having a good win, okay, because the more times you trade, the more times you risk of being wrong. You're not going to be right every time. So if you trade 100 times a day, you might make the same amount of money trading once a day in big size, Again, but you have to marry that out, so you want to be comfortable with that. I think a lot of people like trading. We just like clicking the button. We like getting in. We like the excitement. And unfortunately, that is, why it's so addictive, because you can literally go into, the nth degree with technical analysis and justify a trade in any way. But essentially, your trading system should be relatively complex enough to not mean you get a signal all the time. But then, again, simple enough to understand it. I'm trading because X, Y, and Z have happened. Therefore, I buy this market or I sell this market. And again, the amount of money you have dictates to what extreme you can do that. So the first risk is don't risk too much. Now, I've read a lot of things over the years, and I've read some things from people like Tony Robbins, the well-known life coach. And yeah, I know millionaires, I know billionaires. And it's quite a common theme when you talk to them, and this was pointed out by Tony. And it wasn't that they ever went out to make colossal amounts of money. What they did is not lose money. So the first kind of thing in the mind was how they can refine things, how, to kind of streamline things, make them better. And that really just does apply to trading. You don't want to be going into the market and risking lots of money when you first start. Because it's, if you're trading with a £5,000 account and your first trade is a loser, 20% of your account gone straight off the bat. So you're going to have to make that money back with less money. So the whole point is that, people that make lots of money, people that are successful, they know when to hit things when it's right, but they don't keep doing things when it's not the right time. So don't keep wasting money, wasting the effort, the time, the capital on things that aren't hitting their plan, aren't working with the strategy. They wait and they do other things, and then when the time is right and the feeling's right, they hit it and they make the money. Again, that's how these things work in all different facets of life. It's about doing it when it counts. It's absolutely no point getting a trade on, getting it out, and saying, oh well, yeah, I don't really know why I'm doing that trade, so I'll just get out, and it does exactly what you think. The whole point is of having an idea and then putting your money behind that conviction. So again, your conviction can be anything. It can be a good piece of news. If you just simply waited a long time for a level, or you just identified good patterns and you're just going with it. How well you've traded. Your trading account will speak for itself. If you're up in your account and trading well and have lots of winners, then generally you're reading the markets right. Again, conversely, if you're losing lots of money, maybe you're getting the markets wrong. Always understand what you're willing to gain versus what you're risking to lose. Okay, it's simple. If you're trying to make £500 out of a trade and you're currently £2,000 offside, how's that going to work? Okay, how's that relevant? How's that good in your risk reward, in your ability to make money in the markets? It's not. So it has to be in proportion. So the smaller you can keep this risk, and I know it's easier said than done, guys. I never said it was easy. But the tighter you keep this risk, and the more you're kind of averaging into trades as they go on side, and you've taken that initial spread cost on, and you're just trying to ride that initial volume, momentum, and direction of the trade. The more you can do that, then the more chance you've got of getting that quick big break or riding the trade out because you're on side. Yeah, and that just comes with proper risk management. And again, it's a real fine balancing act, guys, and a real juggling act, but it can be done. Okay, it can be done, and it all comes back to marrying up them fundamentals, them technicals, and having that framework. If you don't have the framework, you don't understand the fundamentals, your risk is irrelevant because you're just not going to be able to read the markets well enough to get in at the right place. So you're always going to have too much risk on. You're never going to be able to get your profit out quick enough. And again, as I said, it's just a matter of time before you erode that capital and you end up losing your money. So again, managing the drawdown is just when you lose money. Okay, it's simple as that. So the ratios depends on what style of trade you are. Some people are a lot more risk adverse, so actually have lots of smaller losers before they have a winner. Okay, because they get out of trades very, very quickly when they're wrong. Other people have maybe 8 out of 10, 7 out of 10. So they'll let the trade go offside a little bit and they'll manage that downside risk and they'll go onside and take some money. Again, it all depends how you are. You might be a fixed stop trader, so it doesn't matter. If it comes back to you, you're out. Well, that's disciplined. You might be a bit more free, so you work with a monetary stop. Okay, so then you can average in and decide when it's time to get out. Fact of the matter is, you need to be having at least 50% winners. Okay, if you've got the right kind of risk reward, therefore, in each trade, you risk X amount of money, but when you make it, you make 2, 3, 4 times the amount. If you only win 50% of your trades in a lifetime, you will still be up money. So that's the ratio you need to work for. 5 out of 10 trades, 50%, that's what you're looking for. And if you have the right risk reward, 1 to 2, 1 to 3, 1 to 4, 1 to 5, then over time you should still be profitable. As I said, it's very difficult to determine because it's different for different types of trader. As I say, it's generally popular when you Google risk or what I should be doing that 1% of each of your trades, yeah, well, 1% of your capital for each of your trades should be used. So in reality, I just don't think that works. I really don't think it works. And I would say really in the markets right now, with the volatility we have, you need to be kind of looking between 5 and 10%. And it's scary, and people don't like that. But that's the way it goes. You want to make any kind of real money in these markets and do some good trades, then I'm saying really you need to start with smaller size, obviously, but then build into positions. So don't buy prices, buy areas of interest. So maybe buy over 5, 10, 15 ticks, and then average in maybe 1 lot, 2 lot, 3 lots, to average a 6 lot position in, or 1, 1, 1, average a 3 lot position, and then you can, take out that initial volatility and let the markets go up. So I'd say anywhere, 2% and below, you're going to find it very difficult to make good consistent money because you're going to get stopped out a lot of the times. And stop hunters, pin bars, stop grabbers, whatever you want to call them, they're in the market. And, it's not individuals or collective. The market knows. How many times have I traded non-farm payrolls and it's done the exact opposite, to what the data suggests. So expected 250,000 non-farm payroll, comes out 310,000, S&P drops 50 ticks. So I say, all right, guys, we knew it's going to happen. Buy lower, average into the low, wait, bang. All the retail longs are out, been squeezed out, 51 ticks, bang, suddenly back to where we started, we're up 50 ticks. The market knows exactly what people are going to do at all times, then it can be manipulated. If they know you're running a 1% risk stop, they know your average trading account is going to be 5, 10 grand. If they move a product, around the technicals, around the fundamentals, 20, 30, 40 ticks in a straight line, the majority of retail traders get out. That's the rules. Simple. Okay? So you have to put that tolerance in and think about it. Start trading with smaller size and build up your positions. Okay? You've always got somewhere to go if you start with small size. If you start with big size, really haven't got anywhere to go. So as I said, you don't really know, when that 50-50 or that 60-40 kind of winners to losers comes in. You might lose 5 trades in a row, then win 5 trades. As I said, if the risk reward is on the right side and you're always making sure you cut your losses relatively small, and when you do make money, it's bigger than that initial risk, then again, even winning 50% of your trades is still in the long term going to make money. And like I said, it's a marathon, not a sprint. If you're trying to get rich quick off these things, it invariably never works. It should never be about the money. And it's difficult. It's taken me a long time to get to this point. And I don't talk in percent of risk, and I don't talk about risk-reward ratios in my own trading, because I just don't do it that way. I know there's always a fixed amount of money I'm prepared to lose in a trade or a scenario, but that comes with thousands of hours of chart time. And it comes with knowing when I get into a trade that I'm prepared for every outcome. And I'm generally prepared for the worst. So I know that if I'm long in the market, now we've just spiked up 20 ticks, I know there'll be elements in my technical analysis and my kind of risk management that knows I might have to get aggressive and go another 20 ticks in order to protect myself and at least get a scratch or get a winning trade out of this. But this again is I'm comfortable with starting with small size. I can start with small size and I can build up to my entire account. I have no problem doing that. But I don't do it every trade. I might do it 1 in 20 trades. But that's the difference between taking a big losing trade on and getting out for a scratch, or maybe getting out for a small loss, or maybe getting out for a profit. If you know you're involved in the right kind of ways in the extremes, then you can use your capital to massage your position, to kind of take on that short-term volatility, knowing that if you get out, you're going to realize that loss. And yes, there is the odd example in every 3. If you get out, you're going to realize that loss. And yes, there is the odd example in every 3, 6, or 12 months where you do take a big hit. But that's trading. Again, I'm comfortable with this. Again, it's all about being aware of your tolerance, your risk, your strategy, and what works for you. I'm happy, to kind of take, a 5, 10, 15, 20 lot position over a number of prices. Because again, it's like this morning when I was doing the live trading show on Tradermo. We saw 9 red candles in the S&P. 9 red candles. Okay, it can't carry on selling for 9 hours. So there was going to be a bottom. So I picked the bottom, made 45 ticks. Came back 2 hours later, 170 ticks up. But it doesn't matter. I took on no risk, practically. I'd waited for the market to drop nine consecutive hours in a row. I picked a good level at the bottom. I got in, I averaged some more in, and I took out 40 ticks. On good size, that's good. That's a good amount of money. I don't need to make the 170 ticks to make it an amazing trade. Of course, as I keep saying, we all want to do that. But taking money, yeah, day in, day out, trading, trade out, that's what it's all about. So doesn't matter how you do it, or as I said, it's always the money, yeah, that lets you keep score if you're winning. Your account keeps going up. You know, it really does make me laugh. People are always searching for that one big win. The biggest win, okay, like I said, was one of my first trades, and that set me in a downward spiral because I could never keep up to it. I could never relive that excitement of making, you know, such large amounts of money in literally no amount of time. That was due to some big fundamental news. You can't re-get that. So it's very, very important that, you know, you see them as a bonus trade and a one-off trade. What you're looking for is them quite boring trades where it's trend channels or Bollinger Bands or RSI and MACD crosses, whatever it is, and it just works. And you get a little bit out of the market. It's not too stressful, but again, it's not too exciting. But you do it. Go in, make money, get out. When you get the big trades and the big bits of data, that's what it's all about. But you know what? Well, there we go, Rudy. You generally start with your biggest trade when you start off because you've got all that pent-up energy, excitement. Then the market grinds you down and you get lazy, you get tired, you get disheartened. Doesn't matter. But generally you make a good trade and you make some money. It's like, yeah, let's keep that on. Then it gets hard and then it gets less interesting. You have less enthusiasm. Then you lose a bit of money. Then you lose a bit of more. Then you lose it all. And then you have to start again. Get all that profit back. It's all about being stoic. It's all about being level-headed. Yeah, got to keep, you know, keep pushing on, guys. Just keep going every day, every week, every month. It's a marathon, not a sprint. You make one big win, protect it, build on that. Don't try and emulate that. That trade's gone. That market condition is gone. I know it sounds boring. You know, you want me to be the Wolf of Wall Street here and start tossing dwarves around and driving Lamborghinis, you know, into walls. I can do that, guys, but it ain't gonna help you. Trust me. I'm here to be your biggest adversary, to be, you know, the truth teller, to be someone you can 100% rely on. That everything I say is bad is because I've done it, and not just once. Yeah, and I've seen people do it. And again, not just once. These things are matter of fact. They're the way it is. It's the truth. If you don't, you know, you don't pick up on this and you don't, you know, adhere to it, you know, it's really tough to have a sustained career in trading. All right, so another kind of basic way of managing risk reward. You know, there's different ways. Now, again, professional traders don't get married to trades. So you might think the market's going up, but it doesn't mean all you do is buy it. You can sell tops as well. What it's all about doing is getting involved in short little dips, little spikes, bits of momentum, bits of volatility. We can all look at a chart in the morning and say, right, that's going to go up, that's going to go, excuse me, that's going to go down. But realistically, you know, again, is that going to make us money? Trading's all about being right at the right time. It's not about saying, I think the FTSE is going to go up. Right? Okay, great, nice one. How are you going to make some money from that? That's what it's all about. And your risk-reward ratios help you. They really do. Because again, if you always just stick to a 2-to-1, you're risking, you know, take your spread out of this. So whatever it costs, you know, when you press that button, you know, for the spread, take that out and just say, right, well, I'm going to risk my spread and, you know, £20, £30, but I think I can get this trade on side to make 50, 60. Yeah, and then all you can do that, when you can do that 7 times out of 10, all you do is scale up your size. So instead of a pound a point, do £5 a point, whatever it is. And that's what these risk rewards are meant to kind of break through the mentality of looking at it in pure just kind of, you know, yeah, I want to make all this money. It's like, no, I want to get involved in the trade with this criteria, and then I either lose this or I make this. And then all you do is adjust your size, yeah, but when you've got that right kind of momentum in your own trading, and you get in, get out constantly to a profit. So I'm just going to go over that. I can't be bothered with that anymore. I've got enough about risk reward. Now, a trailing stop's a good idea because if you do want to run your trades a little bit longer, then you can have a trailing stop. If you've got a fixed stop, and again, this is a term I hate in the market. Oh, I've got a trade on. I've just moved my trade to break even. You might as well just say I've give up trading. I can't be bothered anymore. You know, because what does it matter? You took your risk on, so you get a free trade out of it. 9 times out of 10, if you're running, a break-even strategy, you will break even. Yeah, maybe 8 times, maybe 7 times, whatever. I don't really care. It's a stupid strategy, and the markets are designed to be volatile enough to get you out. Just stop doing it. It's a waste of time. If you get on side, take your profit, okay, or remove your stop. Do something with it. Don't just leave your stop in the market, hanging there to be taken out. It's absolutely pointless. You have a trailing stop. Yeah, that trailing stop will follow your old trade as it goes on side, and if it comes back a certain percent, then it'll still get you out for a profit. Yeah, that's much more sensible than running these break-even strategies. The markets are far, far too volatile. Okay, so don't do it. Yeah, bored of that. So strategies of cutting your risk during times of a downturn. Now, this is more the kind of sensible things. I would say that a lot of people ask me, I've had a few losing trades, Steve. Should I just put more money in my account? And I said, well, no, because that's almost cheating. If you put more money back into your account, then you're just kind of topping up them bad trades and them losses. What you're going to try and do if you've had, maybe a bad trade or a bad day, is just forget about it. It happens, yeah? Tomorrow's going to be a better day. So you don't do anything. But if you have 3 bad trades or 3 losing days, then try to do something proactive. Cut your size, okay? So cut your size or revert back to your trading plan or do something positive. Again, trade a different market or recheck your fundamentals. Paper trade for a day, okay? Just trade on paper. Yeah, go back to a demo account. Do something. Don't just keep doing the same thing over and over again. And I would say, obviously, if you start trading on minimum size, a pound a point, it's very difficult to reduce your size. But unfortunately, that's just the way things go. If you start with minimum size, you've always got a way to go up. But if you start with minimum size, then you have no way to go down. So if you cannot cut your size by 25% or 50%, then what you have to do is paper trade or trade a demo account. Do something. Just do something positive. Because if you don't, then, really, what is the point? Yeah, there's no point keep doing the same thing wrong over and over again and expecting a different result. Okay? So, again, these things have to be proactive and you have to do something about it. I would say the absolute opposite as well. When you're having a good trading session and you're trading well over a prolonged period of time, you have to be confident enough to put your size up. Okay, so your minimum clip can go from 1 to 2, 2 to 4, 4 to 8. Whatever it is, you can be comfortable. You should still give yourself room to average in. But there's no point starting on the smallest small every time you want to trade because you won't attach that right kind of feeling. Okay, there's a different feeling about putting a big amount of size on. Okay, and generally, when you start off with a big amount of size, you go quite a lot of money offside because of your spread cost, and it generally feels scary and bad. Some people like that. But you're only going to make big money with big size. So you need to do it in increments that work for you. You can't jump up the scale. You can't just suddenly start trading £100 a point. It's just not the way it works. Okay, so you have to be proactive, but also realistic. And again, you have to do this. If you continue to trade on the smallest amount you can, you won't progress as a trader. You will not be able to make the money you deserve, to invest in your time, invest in your strategy if you don't move it up. But again, it has to be controlled. You can't make too big a jumps. So I would say, again, if you're starting with maybe £2 a point, over time, if you're trading well, keep a £2 a point, but maybe average in if you're trading well. Maybe kind of as it goes, when you're a couple of pounds on side, bang, buy some more, pay with your spread with your profit, and then let it run on. Again, there's different ways of doing these things, and only you'll know. But if you're trading well, capitalize on that. Because the times you're trading badly, you're going to cut your size down, and you're going to trade less frequently, so you make less money. So in a year, there might be a big, kind of surge of up or making good money. They make really good money because you up your size. Then when you're trading badly, you just trade less, so maybe you're making no money or even losing a little bit. But you have to wait for that good period to return because you're not going to trade well all the time. So once you've reached your target and these kind of strategies, you want to kind of employ. Now, again, you can get too technical with these things, and I think it's very hard to start thinking like this when market is moving fast. So it's like, okay, well, I've made my £100 today, so I'm only going to risk £25 on my next trade, again, because I want to take some money home. It gets hard to do that, and again, you have to be very disciplined to do that. So if you are that disciplined, then that's fine. That should be down in your trading plan. But if you're trading intraday, trading volatile markets, then it's pretty much impossible to do that. So what you're going to have to do is always keep in mind, okay, how much money is the highest point you've been up and how much money you're prepared to go home with. So maybe you make a few £100 very, very quickly, and you say, right, well, markets are moving around, I made a few £100. Worst case scenario, I need to be going home with £100 today. Okay, so then you just carry on trading, and if it looks like the trade's going offside or not going well, get out. You can trade as much as you want. When you hit that £100 mark, no matter what is happening in the world, what's happened, you have to get out and take some money. Because if you don't, you'll invariably lose that money and then go down. So set yourself a monetary target and say, you know what, no matter what happens, I'm up so I can give half away. And that's a lot when you think about it. But generally, if you say 25%, you'll ignore yourself and you won't do it. But if you say 50% of what I've made, I'm going to take that no matter what, and you turn your screens off, then as long as you keep doing that, guarantee you're going to make money over the long term. Some important rules to remember: make sure your trade size, start small to protect, your kind of your downside. Because as I said, when you start smaller, you can always build in. If you start, with too much size on the table, it can affect how you feel, and you can certainly get out of trades earlier. Because sometimes you put the trade on, then you go 4 or 5 ticks offside straight away, and then you get back on side, and then you go offside, and it's like, oh, I'm not too sure about this. Then you get out of the trade, and it does exactly what you think. And that generally comes from the money, not the movement, the money that you've seen. And it affects us all, okay? So be selective. Once you've made your target, sit back, wait for better signals. Again, if you've made money in the markets, why rush? Why get in straight away? You're going to win 2 trades in a row, 10 seconds apart. Probably unlikely. If you ever do lose money, don't ever try and get all of it back in one go, okay? Try and get it back in 2 or 3 trades. And I tell you what, the way you feel, if you lose, a good amount of money, a big amount of money, you will never make it back in 1 trade, okay? And if you do, it's generally luck. But if you try and get it back in 3 trades, you'll be amazed suddenly how different you feel. Claw back half of it, claw back 2/3 of it. All of a sudden, you're back in the black. And it's all about that psychological edge and that kind of seeing your P&L go back to where it was. And again, what's 3 trades in the grand scheme of things? Nothing. If you've taken a big loss, then you've probably been doing bad things. You've been trading A, too much size, B, not trading with the right kind of risk, or C, all of the above. You don't just lose money by accident. It's generally by doing things that you know are wrong, and you've gone against your better judgment. So try and get it back in the right way. A couple of trades, claw some back, and then continue. As you say, if you made your target early on, then bang, there we go. Well, there we go. Perfect example from Chris. 80% down in 5 months, back to 100% flat in 9 months. Well, there we go. I mean, that's what it's all about, Chris. I mean, it's proof, isn't it? And I think we've all got stories like that. If you try and make it back in 1 month or in 1 trade, invariably you end up blowing up. You're putting yourself under too much pressure, too much expectation. So risk management intraday, and again, it all depends how many times you want to trade. Some people, hyperactive, have to be in, out, constantly taking little bits of money. Really, again, it's very, very difficult for me to say, what is the right kind of risk management without speaking to you, on your own. But I'd say generally, if you stick to a 3-to-1 risk-reward ratio on any type of trade, with your size being sensible, you're not going to go far wrong. And trading can be that simple, guys. It can be. If you keep the rules very transparent and you stick to them, okay? Biggest temptation you get in trading is to, when the market's winging around, say, oh, well, I'm just going to change my risk strategy for this, this day because this is exceptional. And you know what? It never really works, does it? So as I said, risk management, the key is the overall general trading success. So tight downside stops are needed to make sure that, your returns aren't eroded. And again, like I said, I'm only throwing ideas when I say about, I personally don't like putting my trades, to stop in for a scratch. I just don't like doing that. I just don't see the point in it. And, follow trading, trailing stops can work for different people. Again, I'm just giving you the ideas. You have to see what fits in with your trading, with your style of market interaction. I can only tell you what can be done. I can only tell you what is right, and I can only tell you what works for me. But then it's down to you. I cannot give you a perfect formula because it just doesn't exist. But if you have all the ideas, you have the understanding, then you can get an idea of what works for you. Yeah? If it doesn't work for you, stop doing it. Try 10, 15, 100 different strategies before you find the one that works for you, and then just apply it to different markets, scale up your size. Risk is always generally going to be dictated by the length of time you can hold a trade. Okay, so, and the size, the amount of money you have as capital. So these equations generally get to a point where they can't really be changed too much. So again, position trading is going to be different. If you're not an intraday scalper and you're looking to hold things over a long period of time, then obviously, your risk management and your risk rewards are going to be different. But again, I think we're here on a spread betting platform because we all would like to trade, a number of times during the day. So your risk strategy and your risk reward has to be, 2-to-1, 3-to-1, about that. So it gives you the time for the quick movements. If you're looking for 10, 15, 20, 100 times your initial risk, then that can't happen in an hourly chart. It can't happen in a daily chart. It will take weeks, yeah, or maybe months in some instances. So you're looking at a different risk strategy. Again, the time element is really important when figuring out your risk strategy. And, it's a simple equation. And again, the ideas I've given you and the ideas for stops and the ideas for ratios are just meant to be a template and guideline. You'll quickly see if you stick to a 2-to-1 or 3-to-1 or 4-to-1 ratio over a number of trades, if it works for you. And it will either work or it won't work. If it isn't working, then you're trading wrong or you're not the right type of trader. Maybe you're trying to be a position trader in a scalping type market, or maybe the opposite. Whatever it will do, it will tell you, what it's all about. So again, that's just, again, you're saying stops are important. The risk reward 2-to-1 is the minimum you should ever do on any type of trade anyway. Momentum trading, again, that goes back to the time element. We're all really momentum traders, be it short-term scalping, over a 5-minute, 15-minute or hourly candle. An hourly candle is still a scalp, okay? It's still a scalp because it's intraday trading. If you're position trading over a daily candle, you have to let the markets close. So that is a position trader. So momentum and risking momentum, it's all about the time you're willing to hold the trade. News trading is one on its own. Now, news trading I do twice a month on Intertrader, and that's trading fundamental data like the non-farm payrolls. Now, that is difficult because it's very difficult to trade the markets when they're that quick with a stop. So yet again, I would say my advice is trade with size that you can afford to take on and off side. So I would say really trade with probably between 2 and 5% of your account risk, or maybe £2 or £3 a pip, depending on your account size, and just be patient and wait and get in and get out. Give yourself sometimes the ability to average in, because as I've said many a time, with fundamental data, the markets can quickly go against you aggressively, but it doesn't mean you're wrong. But if you don't have the ability to average in over prices or give yourself that pain threshold, then you're going to get squeezed out by the market. So news trading, I would never trade with stops, because it's just too difficult. The market's too quick, too volatile, and you're doing too many things simultaneously. So I'd trade with size that you can afford to do stuff with. That's my best way of putting it. Trade with size that you're happy to average in, because you might have to buy yourself a bit of short-term risk, a bit of short-term volatility. Fade that out and let the markets come back. So again, good place to get the news from is Rand Squawk. Again, if you have a live Intrader account, you can get the Squawk. I sit here all day with my Squawk on. It's like a little friend sat in the corner telling you things. You need to know these things. You're looking at things that come out on Bloomberg or Reuters. They're wrote by journalists, and they're already lagging. They're well behind the time. If you're trying to be a quick news trader or in and out of the markets quickly, you need the quickest information, and that will come from live sources like a Squawk. So as I said, the risk management for figure trading is pretty simple. I've done this 45 times or so on Intertrader for the non-farm payrolls. Only ever lost twice. Let the market give you the initial reaction. Yep, it's either going to come back to 50% and do a complete retracement or a continuation pattern. Simple. Let the market do what it needs to do, go up or down in initial direction. It will retrace, then it will either continue in the direction of the initial trend or spike, or it will completely reverse. That's it. That's how you trade figures. There's millions of other ways, I'm sure, but that's the only way that I can say, backs up my stats. The secondary move is also the very most important in any kind of key extension in the market or key bit of fundamental news, key economic data, anything that sent the market a long way out of context or out of what's happened before. It is important. And 80% of the time, You know, a strong directional move will retrace back to that 50%. Yep, you can use the 61.8, 38.2. Don't really matter. For me, the 50%. You see a big candle, be it red, be it green, do a Fibonacci from the high to the low, and you will see 80% of the time it will make an attempt to get back to that 50%, and if it does, it will generally retrace the entire big candle or move, or it will continue in the original spike direction, make a new low or make a new high. Might only be by a few pips, but it will happen. That's an 80% strategy. Okay, look for something out of the ordinary. Okay, fundamental analysis. So fundamental analysis is anything non-technical. So it's anything to do with all the things that are happening in the market right now. Okay, Swiss taking their peg from the euro, fundamental. Greek elections, fundamental. QE, fundamental. Waiting for data, fundamental. All these things are news. So you've got to figure out what it means to you, what it means to your market, how do you make money from it. Okay, not that difficult really. Why is it important? Well, again, anything to do with people sounding clever, people talking, you know, technical speak, you know, in a fundamental way, people listen to. It's either important or it's not. If it comes out from the ECB, Bank of England or Fed, it's important. If it comes out from the BBC, it's not. Traders make money. If it's not interesting to them, it's not going to make them money, it's not going to move the markets, they don't care. Your good source of information are, as I've said, the Squawk. That's more real time. Economic calendar, you can see what they're going to say. Read blogs, read things on Twitter, read anything you want, but keep it relevant. Make it from people that you trust, people that are genuinely right more than they're wrong. That's information. As I said, the market's always going to move in an 80-20 manner. So 20% fundamental information that drives the market, as to all the things I've mentioned, and all the things like non-farm payroll, key economic data, are only in the markets 20% of the time. The rest of the time we're adhering to them technical levels. So any fundamental move will still move between technical levels. So you have to have the balance between the technicals and the fundamentals down. Yeah? It's absolutely imperative that we look at it this way. Fundamentals great because it gives you a time and a place for everything. 9 trading days out of 30, there'll be some piece of information that's worth of note. So a third of your trading month can be attributed just to data. Okay? If everything was data, we'd all be millionaires because it'd be great to trade, but it's not. Technical trading exists so markets can move and people like the bankers can trade. Well, how else are you going to trade if there's no news? Oh, I'm just buying this because I think it's a buy. No one's going to give you £1 million account to do that, but we can justify anything with technical analysis. Anything. That's why people love it, because they think there must be an answer in technical analysis. Well, there's not. Okay? Technical analysis is just a framework you put in play to understand when you get in and out of trades. Right? But the two marry up 100%. So fundamental diary. Keep an idea of what works for you. Non-farm payroll, first Friday of every month, should be on your calendar. GDPs should be on your calendar. Bank of England, Fed, ECB minutes should be on. All these things interest rate provide. They're all free. They're all given to you a month in advance. You should always know where something important, where it is in the world, what it comes out. It's simple as that. So the most important kind of elements for trading in general, FX trading, don't really matter what you trade, is understanding the market cycle. We're either in an inflationary or growth cycle. We've been in the growth cycle for about 7 years. Kept interest rates historically low because we don't know what to do. Okay, so inflation doesn't really matter. You might as well say inflation's a gajillion. All we know is inflation has kind of done what it's done, but everything apart from wages has gone up above inflation. Now, inflation we control by interest rates. So we've kept interest rates historically low. So how on earth can we control inflation? We can't. That's why these politicians and these government guys don't really have a clue what they're talking about. So the growth, all we've done is focus on growth. We've kept having for 7 years, even with the trillions of dollars of QE, pretty poor growth figures. So we're going to start to concentrate less on the growth figures because they're crap and going to remain to be crap, and then go back to inflation. But as interest rates go up, and it might be third quarter 2015, do you know what? It might be 2016 now. I don't know. I don't really care, to be honest. It's not going to affect me. But it will affect millions of people out there that have huge mortgages and huge debt. So it is going to be a factor. But the more we get out of the growth cycle and figure out what's happening with inflation and where interest rates are finally going to rise, because they are going to rise, then we'll focus more on the PPI, CPI, and things like that, more than the GDP, jobs data, etc., etc. And it is coming. Again, back 10 years ago, we're all listening to Jean-Claude Trichet talk about price stability, because that was all we were worried about, was keeping inflation under check. Well, interesting growth. Everyone had a job. There was loads of money. Everything was great. 10 years is a relatively short amount of time to be where we are now. So really, again, people have a short mind when we talk about these things. Growth, yeah, has been manufactured. Inflation is going to be the next topic. So government borrowing, yeah, it's astronomical. Just after this session, go and Google World Debt Calculator and just watch that for 30 seconds. Then you put things into perspective. Trade balance and budget, obviously, the biggest they've ever been, but you have to put them in context of country. And then GDP, broadest measure of what a country does. That's your growth stuff. So that's interesting to traders on all respects. So anything that's going to move the market is major, is big things like terrorist attacks. Okay, we don't like them, we don't agree with them, blah, 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 blah. They're just news. Okay, so good news, things go up like stocks. Bad news, things go up like bonds and gold. So if we see a terrorist attack, which the UK is on the second highest alert of terror, what we've seen in Paris, etc. If we see something like that happen, then obviously there will be a follow through to the markets. I would say don't feel guilty about trading it. It's just news. And unless you did it yourself, then what have you got to feel guilty about? That's just the world we live in, unfortunately. Mercenary, dog eat dog. Like I said, if you don't like it, then, don't trade. So this is an example of the markets after 9/11. Okay, so this is just FTSE. 9/11 happened, bang. 8% of the time, strong directional move will trade 50%. So it did. Okay, so that's a day. So it already kind of like repaired the losses. But who knows what happens to future markets in an event like that? I don't think that would happen in quite that way. So obviously the basics are stocks move lower. So anything that's bad news, be it economic. But obviously the basics are stocks move lower. So anything that's bad news, be it economic, be it terror related, be it anything that's bad to the growth of the world. I mean stocks go down because they're the most affected. Bonds, safe havens go up. So you see a massive spike in gold, massive spike in the Norwegian krone, a massive spike in the Swiss. Yeah, anywhere you think your money is going to be safe. Yeah, that's what happens. So good news, bad news. Again, these are things like the quantitative easing. So we do have good news. We saw a very similar situation with the rumours before the QE announcement. It came out over Bloomberg and the Wall Street Journal that it was going to be 50 billion. So bought the FTSE, bought the S&P. You didn't see anything quite like this, but you certainly saw a big green spike. So again, the good news affects the markets in the same way. We see the only reason why we're topping out in the indices is because of the European 60 billion euros a month QE. I mean, we've sold off a little bit, but that's just profit taking at the top. Well, there's 60 billion on offer. Markets are going to go up, aren't they? We've been feeding off the back of the quantitative easing out of the US, so why would the European be any different? It won't be. So why do they move the market? Well, anything that moves the market is because it's bullish, bearish, hawkish, dovish. So bullish, bearish is just trader talk, technical talk. Hawkish or dovish is just comments. So if someone's talking in a particular bad way, it's a hawkish comment. So again, all these things are more policy related. So if you're talking about people that vote for the Fed or members of the ECB or the Bank of England, they're generally referred to as doves or hawks. And if we're talking about trends or anything technical trading, bullish or bearish. So that's again just the real lingo we're looking out to use. So data, and again, different figures are going to move the markets in different ways. You have to understand if these figures, as I mentioned, are growth related or inflation related. Again, it's different cycles will affect different markets. So it's, again, it's quite interesting, and there's no real roadmap for these things. You have to do it by trial and error, I'm afraid. And some figures you'll get on with, some figures you won't. But the main ones we look at are growth and inflation. Figures drop into one of them two categories. There's only really the non-farm payroll that's out in its own, and that's more of a coincidental indicator because that's the best. The US is still the biggest consuming nation on earth. It's the biggest economy, no matter what people say about China. I don't care about China. The GDP per head in China per capita is about $4,200. It's $42,000 in the US. So China has no place in this. When we talk about the US and, again, policy making and figures of growth, figures of inflation, that filters through to the markets. It doesn't happen in the same way with China. So acts of God, natural disaster. Again, look at your commodities. Look at your soft crops. Look at oil. Okay, all these things with the Saudis pumping up production to kill fracking off. If everyone thinks that's the way it is, it's just not. It's just not the way it is. We couldn't bomb Russia. We couldn't stop Russia with sanctions. So we took off. We took them off of their knees. Yeah, we stopped their ability to make money from oil. Yeah, these things are political. They work at higher levels than political. So the reason that oil's come down is a number of factors. It certainly isn't to stop fracking. Okay, fracking, please. Oh, what was that? Yeah, currency interventions, again, as we saw more recently with the Swiss, okay, that massive gap we saw down, and the Swiss got, massively inflated, so dropped, the dollar dropped massively against it. This is just what's saying what happens with the yen and the Swiss franc, okay? So again, these things are happening in history. So again, being related to other currencies and having a peg, when they're removed, can make massive ramifications through the markets. So this is just an example of how the movement happened with the yen and Swiss franc. Again, I can bring up charts, probably in other presentations of what happened to the Swiss when we saw the SMI biggest drop in one day after that announcement of the Swiss taking their peg from the euro. And since 1989, that drop was. So again, other examples are increase or cut of supply. So isn't more obvious than what we see in oil today. Oil was trading, a year back $115 a barrel. Now it's about 46, 47. You said that a year ago, no one would have believed it. 89p at the pump or whatever it is, people just wouldn't believe it. But that's how things happen. What goes up can go down. Nothing lasts forever. Supply, again, we can see the supply effect in oil again. Absolutely, obvious. Saudi's pumping up supply. Everyone's got the reserves. Okay, supply goes up, demand stays the same, price goes down. Margin requirements, that's been a new thing, with the volatility in the markets and how much people can trade versus what they've got in deposit can change. So we've seen an increased margin. That's why people at Alpari got killed. That's why people at FXM need a $300 million buyout, because you're running too big positions on margin. So when that changes, your ability to trade changes. Don't have the money in your account, you can't do it. All right, guys, that's we're halfway through the Trade for Life course now. So again, lots more things to consider, lots more information as always. The sessions are recorded, so we can always go back off it. But again, these things, really need to be kind of let them sink in. You might have to do this course a couple of times. I know some people here tonight have done that, but there's always new things to learn. But the basic facts of the matter is you have to be prepared. You have to have a plan. You have to have your risk-reward ratio. You have to take money when it's on the table. And you have to keep doing the same thing right over and over again and stop doing the wrong thing. That's the real summary of this. Any thoughts, any questions, guys? Anything you'd like to ask? Okay, so market's really recovered now. Well, not fully recovered, but we've certainly kind of, that 8 hours of selling in the DAX has bottomed out. We picked a good low. We picked a very good point in the S&P. So gold's just holding around, really, again, trying to get back to that 1300 mark. But really, across the markets, not looking terrible. We've got Apple shares coming out at 9:30 tonight. So Apple trading 204 points down at the minute. So again, big things to look out for. Could be ramifications for the markets in the morning if we see, a good or bad Apple data. Okay, Chris is saying, is it worth trading anything other than US hours? Well, you can trade whenever it's convenient, Chris. The markets are so efficient now. They work, 23/6 these days. So I'd say you generally get a good trading opportunity around about 10 o'clock London time and about 3 o'clock London time. So after the UK markets have opened, you generally get a good trade leading into the US Open. And then generally half an hour after the US Open, you get a good trade. It'll either be a trade continuation or reversal. So look at the charts. Yeah, if the markets have just gone down, 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 down into the US Open, don't expect them to bounce up. Expect them to go down and then up, and likewise. So I'd say 10 o'clock and 3 o'clock London time are where I find the best opportunities to trade. Yeah, absolutely, Rudy. Again, these things take time. It takes a long time to learn these things, as you well know, because you've been with me a long time. But each time you get a little bit of information, you get a little bit closer, a little bit better. And as I keep saying, I don't want to keep harping on about it, but it's a marathon, not a sprint. By the time you've watched 1,000 hours of charts and done this stuff for 14 years, if you've done that every day of your life, you'll just know more. It's just time, guys. Just time and managing your expectations, being realistic. All right, guys, anything else, get me on Twitter. That's the best place to come and play with me, at Steve Ruffley. Ask me any questions you want, and I'm generally kind of checking it most of the day. So send me a chart, send me some ideas. It's all good. Alright guys, anything else, get me on my email, sruffley@tradermaker.com, and it's been a pleasure. Alright guys, have a great evening.